Thank you, everyone, for joining us for the best hedge against inflation, invest in this asset class webcast. The anchor tenants of a commercial real estate property are one of the most important factors of an investment opportunity. Strong anchor tenants come with a number of benefits like lower credit risk, higher foot traffic, and the ability to attract other tenants to the property. When it comes to consistent cash flow and value add potential, grocery anchors stand above the rest. Join us and your host from First National Realty Partners, Managing Director Drew Carpenter, for an in-depth look at why grocery anchor commercial real estate belongs in every investor's portfolio. Drew, I'm going to hand it over to you and Sam Pirelli today. Thank you so much.
Thank you so much, Jeremy. As Jeremy said, my name is Drew Carpenter. I'm one of the managing directors here at FNRP. I want to personally welcome each and every one of you on the call today. It's a true honor to have you with us. Now, inflation continues to be a hot topic. In our opinion, it's going to continue to be one for some time to come. As with any economic condition, there's pros and there's cons, really depending on how you're positioned with your investments. Inflation, harmful in many, many ways to many people. It's really not something you want to have excessive amounts of like we're seeing now, but we really can't change the fact that it's here. The good news is, though, that commercial real estate, specifically grocery-anchored essential needs triple net real estate, is really uniquely positioned to benefit from inflation. So today, we want to share our perspective and strategy. Before we get into things, though, just a quick legal disclaimer. This presentation is for informational purposes only, should not be considered a solicitation to purchase securities. That can only occur via private placement memorandum. Past performance is not an indicator of future results. There's an element of risk in any investment. You could potentially lose your principal. FNRP can only work with so-called accredited investors with income and net worth requirements as shown on the screen. Lastly, we've made every attempt to disclose real and actual figures, but no warranty or representation is made to their accuracy, and terms are subject to change. In the next hour, we'll cover how we define inflation, inflation's impact, where to invest during times of high inflation, and after that, I'll give you a brief rundown of our firm, First National Realty Partners, and outline one of our current raises, our Opportunity Fund, which is an excellent way to gain diversified exposure to some really incredible assets. So first, let's get clear on what inflation is exactly. As I'm sure everyone knows, the common definition of inflation is simply rising prices. Now, another definition that we like a little bit better is that inflation is a decline in our purchasing power per dollar. It can be thought of like an invisible tax. Now, the bad news is, if you ignore inflation, over time, it is a very reliable and a very powerful destructor of wealth. You can think of it like compound interest working against you. So it really does need to be accounted for. The good news is, once you're aware of inflation, there's several ways to position yourself to make it work actually to your advantage. And we're going to get into some of those strategies very shortly. But first, I want you to take a look at this graph. It shows if you had $1 million of purchasing power in 1971. So $1 million, 1971. You decide to play it safe in the traditional sense and parked it in a no-interest savings account. Your $1 million of purchasing power would be equal to $139,000 of purchasing power today. So playing it safe would have effectively netted you an 85% loss in purchasing power. So really, it's undeniable that inflation is absolutely not something to be ignored. So the next question is, are we in inflationary times? Is this something we need to worry about right now? And surprise, surprise, as you've likely heard, the answer is yes. What's happened in the past 2 years is that inflationary pressure has been greatly accelerated by COVID and central bank and government actions around the globe. If you take a look at this slide here, overall inflation up 9.1% based on the latest figures. Chicken up 18%, eggs up 33%, milk is up 16%. Now, increasing food prices is probably pretty easy for the more fortunate among us to shrug off. But really, this pattern plays out up and down the line, with items that impact everybody no matter your level of wealth. For instance, gasoline is up almost 60%, and energy is up 41%. As you likely know, gasoline, fuel, and energy are essential to almost everything, but new real estate development in particular, both commercial and residential. The point is and it's very, very clear, is that the price of all types of commodities up and down the line are going up much faster than in years past, which means that our purchasing power per dollar is going down at the same rate. So, in essence, you know it, I know it, the horse is out of the barn, so to speak, and inflation is on the rise. Now, one thing to note is that this has come to a surprise of even the Fed, who not too long ago officially retired the term transitory when discussing inflation. That's pretty telling and should really make your ears perk up. So now let's take a look at what's causing this inflationary trend. You've probably heard about pent-up post-pandemic demand and consumers being flush with cash from government stimulus. Now, this has driven demand and wages up, creating what many consider a wage price spiral. The increase in demand for goods is very predictably causing a shortage of supply of both goods and workers. Essentially, it's too many dollars chasing too few goods. Econ 101, supply goes down, demand goes up, and consequently, prices are going to rise. Now, much of this comes back to central banks, not just domestically, but really around the world, printing money at an unprecedented rate. There's been trillions of dollars of government stimulus put into the hands of consumers, and prices have risen very sharply in parallel. Now, you see this graph here. This is the amount of dollars currently in circulation, and you can very clearly see the spike in 2020. But this is true not only for the dollar, but for currencies across the spectrum. There really is no safe haven for fiat currency right now. And what we're feeling is the ripple effect of that cash entering the system. Now, you're probably thinking, Drew, I know this, I watch the news, but please stick with me, because I want to dive into what this means to us as investors and the best way to navigate this current inflationary landscape. Now, you've likely heard that in a period of high inflation, there's a common ethos that says traditionally equity goes up as prices go higher and debt goes down in value. You'll hear people say inflation is bad for the economy. Ultimately, I'd agree. But all you need to do is accept that it's happening and try and make it work for you as an investor. Now, really, the goal of central banks and governments long-term is price stability. It's a sign of an efficient and stable economy. Again, though, our opinions really don't matter. What's good for the economy, in a personal sense, really just depends on how you're invested. And we're currently in a period where being in equity or ownership is the only way to keep up. So if you're on the other side of the fence, if you're lending money, if you're buying bonds, or you're just holding on to cash, you're actually losing purchasing power, and that's really not where you want to be. So what is the best way to position yourself as an investor during times of high inflation? Now, as I mentioned, you want to be an owner, not a loaner. And the reason is, when you lock in your return rate, let's say you buy government bonds, which is just loaning the government money, or you hold private mortgage notes, whatever. You're locking in today's value of those returns for years into the future, when the purchasing power of those returns is going to be much, much less. You don't get to ride the tide up with inflation, so to speak. Your returns are chained to money's value in the year that you locked in those terms and bought those bonds or notes. And inflation is eventually going to put you underwater, and that's just a really bad deal. So during an inflationary period, it's best to own assets and equity, and it's bad to own debt. Because the price of the asset you own, it's going to inflate with everything else. You ride that tide up alongside inflation. At the same time, the payments you make on the loan that you took out to buy those assets are hopefully fixed for the duration, or at least capped. Those payments are not going to inflate. They become worth less and less as inflation does its work. That's great for you. What this does is it creates a fuse burning at both ends, where the debt you borrowed costs you less and less in terms of spending power as inflation happens. And as inflation happens, your asset is worth more and more. This is how you want to be set up. Now, the key in an inflationary environment is you want to own equity. You want to be an owner. You want to have assets. You don't want to be involved with bonds or lending money, because as soon as you lock that rate in, you're never going to do any better. For example, if you buy government bonds at a 3% interest rate, you're never going to do any better than that 3%. That's as good as it's going to get. If inflation is at 9%, you can do the math on that. Whereas if you own equity, you've got the ability to have some price appreciation. You have the ability for your cash flow to go higher as well. Your investments are going to inflate in value while your loan payments remain the same. You ride that tide up with inflation, and your assets, of course, keep pace. It's kind of funny. In real estate, everyone's looking for high appreciation areas and properties. Appreciation, really, if you think about it, is just a sector-specific form of inflation. Now, a lot of people will tell you inflation, oh yeah, that's very, very bad. But when their house appreciates, of course, that's a great thing. And it's very strange how those terms are frequently interpreted so differently. Now, take a look at the second bullet here. In real estate, a very important figure is the NOI, or the net operating income of a property. Now, one easy way you keep up with inflation is you grow your NOI, your net operating income. And there's multiple ways to do this that are built into the real estate market and are very reliable, assuming you're an owner. Now, first off, you'll want rent increases built into your leases. Most of our leases at FNRP that we do with these national tenants have built-in escalations in the rents, specifically to allow us to keep pace with inflation. It's standard and expected in the market. And another way is through leasing up of vacant space or through value-add initiatives at the properties. That lease-up adds value to the properties, which allows us to raise rents even further. And with triple net properties, we're able to offset inflation on expenses like taxes and maintenance because the tenant pays for these. They're passed on through. And more on that shortly. That's a huge advantage. The point is, real estate is a great way to make sure you're on the right side of the fence and you can ride that tide up when inflation is high. What you don't want to be is a loner in periods of inflation where your returns are fixed and get eroded away. Now let's take a look at a few inflation hedge myths. So during inflationary periods, people often flock to gold or really on a broader-based commodities. And while commodities like gold may be a reasonable store of value, in our opinion, they're really not the same as an investment, at least not a very good one. Now, primarily because they don't produce any cash flow. When you buy gold, you're speculating that the price is going to go higher. It's really not the same as owning an ongoing business or a piece of real estate. So commodities, while they may hedge and keep pace with inflation, that's all they're going to do. They're only a store of value. You're speculating. You're never going to have any cash flow. Excuse me. And the same story with TIPS. You probably heard of these, Treasury inflation-protected securities. They are really only that in name only. We had Jared, our Chief Investment Officer here at FNRP, take a look at where TIPS are trading right now. These are government bonds that supposedly keep up with inflation. And on a short-term basis, they're actually yielding negative results, almost like European bonds. So do you want to go into gold where you can't generate any cash flow? Do you want to go buy government bonds that supposedly keep up with inflation but are actually negatively yielding? All while gas is up 60% and building costs are through the roof and rents continue to rise? To us, it just doesn't make a lot of sense, which brings me to my main point. That in our opinion, the ultimate hedge against inflation is necessity-based or essential triple net commercial real estate. And let me tell you why we think that. So the first thing I touched on briefly a little bit earlier is that when using this triple net structure, 99% of the time, we're passing our expenses through to our tenants, no matter how much they inflate. They pay us the base rent, and then they additionally pay us the triple net charges. That covers taxes, that covers insurance, that covers maintenance and utilities. So what that allows us to do is you have this offset of any increases in the costs. So if taxes go higher, the tenant pays for the increase. If electricity goes up, we're passing that through to them. Same story with maintenance, repairs, labor. We're passing that through to the tenant as well. So we've got this great offset that allows us to protect ourselves against increases. Whereas if you own, for example, an apartment building or an office building that's not set up in a triple net structure, think about it. If expenses inflate 7 or 9% per year, that's going to be coming directly out of your cash flow. When you own triple net real estate, which most of our deals here at FNRP are, you're able to pass those expenses through to the tenant, which is just absolutely huge in times of high inflation. Now, additionally, I mentioned built-in rent increases in our leases. This is a wonderful perk to commercial real estate. Most of the leases that we inherit, and almost all of the leases that we execute new have a built-in escalator. Now, the amount varies, but a lot of times the increase is quite significant. 10% really isn't unusual in the market. And what this allows us to do is keep up with inflation or even outpace it many, many times. So the beauty of triple net real estate is that our asset appreciates right alongside inflation, while the expenses are paid by the tenant, and we can build escalations into these leases to make sure our returns keep pace with inflation. We believe that it's an incredibly potent hedge, much more so than bonds or commodities like gold. So that's why we really love essential triple net real estate. Now, I mentioned earlier essential or necessity-based triple net real estate several times, and I know I haven't explained that quite yet. So our focus as a firm here at FNRP is on grocery-anchored real estate. That's our bread and butter. But the same applies to other essential triple net real estate. Could be medical offices, could be essential industrial. The key is that the property provides something that the public is always going to want. Rain, shine, COVID, no COVID. The public is going to desire whatever this center is supporting. And those types of real estate are comparatively very, very sheltered from economic downturns and cyclicality. We had a lot of drug and grocery stores in our portfolio all throughout COVID, and sales were up 20 to 25% at most of them. During the pandemic, we were incredibly grateful to be in essential real estate. We talked to lots of multifamily owners. They were dealing with eviction memorandums, people not paying rent. We talked to hotel operators who were operating at 5% occupancy. And it really becomes clear how durable essential needs real estate is, faring so well during such a grueling stress test. So necessity-based real estate, very, very unique in this respect, in its ability to do very well during both times of high inflation and during recessions and the economic cyclicality and downturns when they do come around. So now, let's talk a little bit about how to find great real estate investments. Now, first, obviously, you can own and operate them personally. You can go out and acquire, invest your own money, buy your own assets, lease and manage them. Certainly not a passive investment, though. In most cases, you're buying a part-time job at the least, and you're operating a business. So buying properties directly, sort of in its own category. You probably know if that's right for you or not. Now, the other three you see here, these are all passive. Public REITs and private REITs will benefit from inflation. But one caveat to REITs is that they lack a lot of the tax advantages. You're not going to benefit from depreciation with a REIT, and your 1031 privileges are much, much more complicated. REITs are also liquid, which we consider much more of a bug than a feature. It means they're much more volatile than investments with longer lockups like commercial real estate due to that instant price discovery. They're also becoming more and more correlated with a broader stock market. So that leaves private equity deals or private equity deals that break down into funds, the last two bullets you see. Now, the beauty of these is you get all the advantages of private real estate. You get the benefit of keeping up with inflation. You get the tax benefits. You get the 1031 ability, cash flow appreciation, and they're completely passive. You don't get any calls about frozen pipes or trash or toilets. And it's because of these reasons that we think private essential grocery-anchored centers are a best-in-class investment, and doubly so in times of high inflation. So that's why what we specialize in here at First National Realty Partners. Now, with that in mind, let me walk you through an overview of our firm and how we think about investing. Now, we define ourselves as a vertically integrated, opportunistic, value-add private equity sponsor. We're based out of Red Bank, New Jersey. Currently, we have 10.8 million square feet in our portfolio. We offer investors stable, passive investment opportunities, bringing all the advantages of commercial real estate ownership, cash flow, appreciation, and tax benefits, all without the hassles of acquiring or managing that real estate. So we have over 140 real estate professionals now at our firm here at First National. We realized very early on that being able to source talent nationwide was a huge advantage. So we've been a fully remote team since well before COVID. We've optimized for competence over location, and that's just served us very, very well. Now up top, you can see our founders and chairman, Anthony Grasso and Christopher Palermo, our CEO, Andrew DiNardo, managing principal, Ken Chapman, our chief operations officer, Kurt Padovano, Jared Feldman is our Chief Investment Officer. Deepika Bajaj is our VP of Finance. Our Chief Marketing Officer is Casey Stanton. Fred Battisti, our Head of Leasing. Zane Knockby serves as our in-house legal counsel. Joe Palermo is our Head of Investor Relations. And Bill Como is our CFO. You can read everyone's bio at FNRPUSA.com. I assure you, an incredibly competent and accomplished group. So we've worked on over 141 million square feet of real estate deals. Our leadership team has over 177 years of experience and has transacted on over $30 billion of real estate. We often get asked, what makes FNRP unique? There's a lot of syndicators, a lot of sponsors out there, and we think it boils down to these three pillars that you see at the bottom of the screen here. The first is our Dragnet acquisitions model. The second is our investment thesis that we call tenant-centric value-added investing. And third, our asset management approach that we call FNRP 360. And I'll touch just briefly on each one of these. The first being our Dragnet acquisitions model. Now, this is how we vet our properties. We have a saying here at FNRP. It's become a North Star of sorts that guides our acquisitions. That we want to look at 1,000 deals for every one that we pursue. And casting a very, very wide net, being incredibly picky about the deals that we chase, has served us very, very well. We've developed over 60 specific boxes that need to be checked before a deal makes it to our investment committee. If it doesn't have all those boxes checked, we're going to toss that deal out. We're not going to move on it. And consequently, in order to source enough deal flow to find opportunities that check all those boxes, we take a nationwide focus. We leverage our relationships with the brokerage community, the institutional seller community, and the family owner seller community to source our deals. And we run this dragnet across the entire country. We evaluate thousands of on and off market deals, nearly all of which we're going to toss out of the pipeline for one reason or another. Maybe the anchor tenant sales aren't good enough. Perhaps there aren't enough national tenants at the center. The population density isn't strong enough. Or, quite frankly, often the returns just don't make sense at a certain price point. So after we take all those factors into consideration, we're hopefully left with one deal that we believe offers the highest return for the absolute lowest risk. We look very, very hard for that asymmetrical risk to return ratio. It's difficult to find, absolutely, but it is out there if you have the resources and wherewithal to look. So here's some of our recent acquisitions that did meet our criteria. Inverness Corners, this was a Winn-Dixie anchored center in Birmingham. Brook Highland Plaza, also in Birmingham, just down the road actually. Dauphin Plaza in Harrisburg. Dauphin Plaza was a Price Right anchored center. Tannehill Promenade in Bessemer, that was a Publix anchored center. And then you see Kroger anchored center, Consumer Square, and Shaw's that was in Hooksett, New Hampshire. Beautiful, beautiful center. So here I ask about our dispositions and our track record quite frequently. A few recent ones here on the screen. Most recently on the far left, a pick and save located in Wisconsin. This netted our investors a 45% annual IRR. Phenomenal return, no doubt. Linate Plaza, this was a core deal, already stabilized when we bought it, still returned 13.5% for our investors. And finally, Colony Business Park on the far right. This was an industrial property. We were able to add several $1 million of value, short hold, netted our investors just under 14% IRR. Our real estate owned schedule, we would love to get you a copy of that. Every property we own, what we paid for it, and its current value. It's an excellent way to get an idea of our track record and our scale. If you'd like a copy, drop a note in the chat, and we will get that right out to you. In total, though, we're right around $1 billion of owned assets. So now the second thing that makes us unique is something that we call tenant-centric value-added investing. And this is really just a fancy way of saying that we leverage our relationships with our tenants to add a lot of value, both to their business and to ours. So the first benefit that this focus on our tenants' needs gives us is just a tremendous amount of intel about what these national tenants need to make a deal work. When we're looking at a potential deal and we see Kroger as the anchor, for example, well, we already have 7 or 8 other Kroger deals in our portfolio. We have an excellent relationship with the brand. We work almost daily with the heads of real estate at these national brands. So it's just a huge advantage, the scale that we have. And because we've cultivated relationships with most of the major national tenants, this lets us get the scoop on a deal very, very quickly. We know right away whether that deal is going to be right for us or not. It's as simple as a phone call. And the second thing our tenant-centric approach does is position us to add value by leasing up space or doing value-add initiatives very, very quickly. Very frequently, even prior to closing, we'll have a center leased up. One thing about having a national platform is that you could show these national tenants multiple options nationwide within our portfolio. And because we understand their needs better than most from working with them on a day-to-day basis, it makes them really want to work with us specifically. And that means a win for them, and it means a win for us and our investors. So here's just a few of the national brands that we do have close relationships with. Walmart, Whole Foods, Home Depot, Tesla, CVS, Lowe's. This really just shows a small slice of them, though. So the final thing that we think makes FNRP unique is something that we call FNRP 360. And this refers to our vertically integrated business model. We've made the conscious decision to bring every single function in the commercial real estate process in-house. So whether that's accounting, property management, legal, leasing, asset management, acquisitions, or dispositions, we don't outsource those roles like most private equity firms do. And this allows us to move faster and more efficiently. In the end, we really feel that nobody cares about our properties or our business more than we do. And there's really no question this vertical integration maximizes asset performance and it improves our returns for our investors. So that's why we've coined our insourcing process, so to speak, FNRP 360. So with that in mind, I'd like to give you a quick rundown of the details of our grocery-anchored Opportunity Fund. This is a phenomenal way to receive all the benefits of institutional essential needs commercial real estate in a diversified fund that's spread across multiple properties, all grocery-anchored centers nationwide. So a brief outline. It's a $50 million fund. We're raising and deploying $5 million per month into multiple past and future grocery-anchored retail deals. So let me tell you why we chose to adopt this fund structure, in addition to our single property deals that we still offer very, very regularly. So we created the fund for primarily three reasons. The first reason was to offer a way for our investors to diversify their investment across multiple properties with just one allocation. I'm sure everyone on the call here is very familiar with the benefits of diversification, so I won't rehash that. But that is the first reason we developed the fund. Now, the second reason we started the fund was to provide a place for our investors to reinvest their dividends. Many of our investors, they don't need the distribution payments that we send out quarterly and would prefer to keep those dollars working for them to compound. So if you're invested in any other single property deal with FNRP, we can now automatically direct your quarterly distributions into the Opportunity Fund so those dollars can keep working for you and making more dollars. Now, the third reason we started the fund was to provide a way for our regular investors to get guaranteed placement into our future deals. Over the past couple of years, as our investor base has grown, our deals have been filling up faster and faster, frequently even prior to the end of our pre-sale. So we wanted a way to offer folks secured, guaranteed space in our upcoming deals, and the Opportunity Fund structure allows us to do that very conveniently. So that's why we created the fund. Let me tell you a little bit more about how it works. In short, when you invest in the Opportunity Fund, it's functionally no different than simply divvying your allocations up and placing them into a handful of our currently owned property deals and future deals. So when your investment is allocated into the fund, your dollars will spread out into all the properties the fund is currently invested in. I believe we're currently investing the fund dollars into 6 properties with more to come. And your investment will continue to dilute into those future deals as more deals are added to the fund's holding. So your investment will become more and more diversified over time. So the next question we usually get is, when is the capital repaid? And since this is a closed-end fund, once we reach the $50 million invested, we will stop investing fund dollars into new deals, and we'll repay investors as those properties are liquidated at the end of their holding periods. Now, holding periods for FNRP, of course, based on a variety of factors. Most of our holding periods are between 3 and 7 years. The majority of them are either 3 or 5. So, compared to a single property offering from FNRP, very little else changes. You still get quarterly cash flow distributions. You still get the tax benefits. Aside from 1031 ability, that is probably the one negative to the fund. You can't 1031 out of it. And the fees are exactly the same as they are on the single deal level. So you can see our projected returns for the fund on screen. We project a 12 to 18% total annual return, a 6 to 9% average annual cash distribution. The grocery-anchored properties that the funds invest in will be held between 3 and 7 years, and capital paid back as soon as the properties are sold or refinanced after their individual 3 to 7 year holding period. One important note, all projections you see on screen there are net of or after fees. There are no additional fees for the fund. Only the standard deal level fees are assessed, and those are baked into the projections that you see on the screen. And another note, our projected returns are based on our historical returns on nearly 8 million square feet of currently owned grocery-anchored real estate and our current portfolio of over $1 billion of the same type of asset. But of course, this is an investment. These are our projected numbers. So let me tell you a little bit about the kinds of assets that we target and why. We're very specific about what we'll consider. We look for well-located grocery or necessity-based anchors with a very strong preference for national tenants. Just like you saw a few slides ago, the Whole Foods, the Walmarts, the Lowe's, the Home Depots. We want those extremely creditworthy tenants, many of which we already have relationships in place with. We also require stable and increasing cash flow on day one. We're very picky about market demographics. We look for growing markets with diverse employment bases and very, very strong economies. We look very hard at the micro market as well. What's next door? What's across the street and in the immediate area? So by doing so, our acquisitions have been incredibly resilient and performed very, very well during periods of economic uncertainty like COVID. So to recap, you can see the projected returns of the fund here. As a reminder, these projections based on our historical returns of about 8 million square feet of currently grocery-anchored commercial real estate and our current portfolio value of over $1 billion of the same type of asset. If you are interested in learning more about the Grocery-Anchored Opportunity Fund, I highly encourage you to set up a call with one of our investment advisors like Sam Pirelli, who's here for Q&A right now. Demand has been quite high every month, and like I said, we're capping the fund at $5 million per month. So if you are interested, act fast to secure an allocation this month. You can do that by visiting fnrpusa.com/call. Again, that's fnrpusa.com/call. You see that on the bottom of the screen there. That about wraps it up for me. We've got Sam Pirelli, our Vice President of Investor Relations, here for some Q&A. Sam is a wealth of knowledge and experience, and our investors very lucky to have him on board with FNRP. So please type your questions into the chat, and Sam, I'll let you take it away. Are you still with us?
I'm with you, Drew. Excellent presentation. As always, thank you for having me on. Can you see me all right?
We can hear you.
Hear and see you great.
All right, awesome.
All right, Sam, we have a couple of questions in already, and I'll just read them to you. So, Chase Edwards, what's the benefit of investing in the fund versus one of the individual deals?
Yeah, Chase, thank you for coming on. Appreciate the question. And what I would say is the main benefit to doing the Opportunity Fund comparative to our individual deals, as Drew briefly alluded to earlier, you get immediate diversification. The fund is currently invested in 6 properties. I think we're in the process of allocating towards our 7th now. So by making one investment, you get exposure to all of the properties that are currently in the portfolio, as well as ones that will continue to get added down the line. So the main purpose of the fund, we really see it as being utilized as the backbone of your portfolio, so to speak, where the majority of your allocation might be in the fund. And then if you see some individual deals that you really like and want to be more heavily weighted in, you could allocate towards those as well. But again, just to rehash, the main benefit towards this fund comparative to our individual deals is the diversification.
Okay. Walla wants to know, is this a standard PE fund with capital calls during the investment period?
Yeah, so I'd appreciate the question. And no, although capital calls are something that always can be done throughout ownership, we have never done a capital call to date. We're typically very conservative with our approach. We set aside enough funds for reserves that we could use throughout the period of ownership. And we also try to raise enough capital up front so that the capital you originally invest is all the capital we'll need throughout the period. So what you can expect for the individual deals of ours, as well as the Opportunity Fund, is that at the time of allocating, we'll kindly ask that you execute your documents within a 5 business day period, give you time to review anything if you need anyone else to review it for you. And then after that process of completing your documents, we again kindly ask that you fund your investment within another 5 to 10 day period from there. So when you invest in one of the deals with FNRP, you'll be providing your capital contribution up front, and then we will not be likely to do any capital calls down the line.
What about 1031 exchanges? Are you able to 1031 into your fund?
So for 1031 exchanges, we do not have them available on the Opportunity Fund. And to give just a little bit of base knowledge about it, the reason is that when you do a 1031 exchange, you actually have to identify the replacement property in which you are investing in. And the way that this fund works is that we're currently in the 6 or 7 properties that we spoke about, but we are going to continue to add new properties to this fund over time. So there would be no way to upfront identify all the properties for a 1031 exchange, which is why we can't accommodate it. But with that being said, we do accept 1031 exchanges on each and every one of our individual deals. If you were interested in learning more about the process from identifying the potential replacement property throughout the entire process, would encourage you to go to that link on the screen there, fnrpusa.com/call, to schedule a call, and I'd be happy to provide you with more information regarding our entire 1031 process and what deals we would currently have available.
Okay. We've got someone from Texas State. It looks like they want to know, with the shift from in-person grocery shopping to ordering online from sites like Amazon, there have been less brick and mortar grocery stores. Do you see this fund growing with that trend, like a diversification away from grocery?
Yeah, so I think overall it's a great observation. And one of the things that we're seeing is that although there is a large move for people ordering things online, at the end of the day, those have to get fulfilled from somewhere. And they're not going to get fulfilled for food from somewhere multiple states away. So say you order groceries online, it's highly likely that whether you're ordering them through a Kroger or a Whole Foods, which, as you're alluding to, partnered with Amazon, they're utilizing these shopping centers as the last mile distribution facility, so to speak. So a lot of the stores that we're purchasing have programs in place where, although the main source of income is through that brick and mortar, they're also accommodating online orders where you can order your groceries online. Someone from the grocery store will put your order together, and whether you're using some sort of delivery app or picking it up yourself at the store. So these stores are still benefiting, even though there's a large shift to online. We try to work with tenants that are internet resistant, so to speak, and also are with the times and utilizing these types of strategies to boost their sales. So yes, we think that as this continues to be a trend with people ordering online, these grocery stores will be the ones to fulfill those orders.
Okay. Can you remind us again of what the minimum is?
Yes. So for all of our deals, individual as well as Opportunity Fund, the minimum investment is typically $50,000. What I always say is that we encourage you to get involved at an investment amount in which you're comfortable with, but at the same time, you'll be motivated to do more and it'll move the needle for you when we succeed. It really isn't about how much you invest in a deal, whether you're getting started at $50,000 or coming in at $5 million, like some of our larger investors. We're going to close the deal out regardless. What it's really about is building that trust, confidence with us over time. So again, $50,000 is the minimum investment. And if you have any questions or need accommodations, please reach out.
Okay. Another question. Are certain geographies better, or does this strategy work location agnostic?
So we have what we call a Dragnet acquisitions approach, where we are looking all over the country for deals, where, of course, there's certain areas that we might be geographically prone to looking for, where there's population growth, good density, good demographics. But at the end of the day, we really are looking all over. We don't want to rule anything out. So we'll take a look at properties nationwide, but yes, we do seem to have a pretty heavy focus in Midwest, some in the South, growing states. So yeah, we look all over the country. We haven't done any properties internationally yet, but we are as far east as New Jersey, and recently we're in the process of acquiring a property in California. So we're spanned really all across the country.
Also, who are some of the better grocery tenants?
It's a great question. We work with a lot of grocery tenants. We have a very successful center called Cedar Center South that's anchored by a Whole Foods. We're in the process of dispositioning an asset now that was anchored by a ShopRite in Uniondale, New York. We did really well on that one. That was a property we bought back in 2020. Held it for approximately 2 years, and we're looking to disposition it now. And those numbers are shaking out to be about a 25% net IRR to our investors. So ShopRite's a tenant we love. Kroger is probably our most recurring tenant that we have throughout the portfolio. And another one that comes to mind as well is Aldi. So as you'll see, we really have everything across the board, from some of the, not what I would say lower end grocer, but more of the affordable grocers, comparative to some of the even higher ends like Whole Foods. We work with a lot of different grocery tenants, but if I had to say, top three off the top of my head in our portfolio would probably be Kroger, Aldi, as well as Whole Foods.
So Kevin has a very specific question about the fees. Can you let him know how you can give him a breakdown on the fee structure?
Yeah, so we're very transparent and straightforward with the fee structure. We charge an asset management fee, which is typically 1% of the purchase price per annual, or 20% of the cash flows. One thing to keep in mind is that all of our fees at the firm are reflected in our return metrics, meaning we're not putting out project level returns where you then have to go back and calculate what your actual return is. Everything we put out is net to the partner, so after fees have already been considered. And then there's also a carried interest structure, which depending on the asset and deal ranges from 20 to 30% of the profit. And again, if you wanted us to furnish you with a copy of a PPM to really take a look at all those fees and have everything highlighted, we'd be happy to provide that for you. So just reach out and schedule a call, and we could walk you through the whole PPM.
Chase wants to know, are K1s received?
Yes. So Chase, at the end of the year, what you can expect is we will provide you with a K1. We're really adamant about getting everything out in a timely manner. I've heard horror stories about K1s going out in July, August. We utilize a tax firm, CohnReznick. They're based in New York City. They've been doing our K1s for us for quite some time now. And we try to get everything out by mid-March. So what you can expect is that if you invest in one of our deals, if you're a limited partner, investing cash, you will get a K1. That's your partnership tax return. We'll provide it for you in PDF form. It'll be located in your investor portal. You'll just have to download the form and forward it over to a CPA or an accountant. And for some of the investors on the call that might be familiar with the process for 1031 exchanges, as you may already know, the tax form will be slightly different for a 1031, where rather than a K1, you'll get a trial balance and a depreciation schedule. But for any of our investors just looking to invest cash, coming in as limited partners, you will get a K1.
So Kevin wants to know, can you please confirm that diversification of the portfolio has the additional benefits of cross-collateralization of all assets in the fund versus individual standalone investments in each deal?
So Kevin, to be completely candid, I'm not sure if I'm understanding your question correctly, but happy to provide you with a list of the properties that are allocated in the Opportunity Fund currently. Just to try to give you a better understanding of it. The way it works is that our individual deals are done on a deal-by-deal basis where they are not commingled or affected by any of our other properties, whereas the fund has 6 or 7 properties already allocated, and then we will continue to allocate over time. So at any point in time, we can provide you with a list of the current holdings of the property to give you a feel for how well diversified it is, the type of tenants that are at these assets, and things of that nature. So hopefully that answers your question. And if not, would encourage you again to schedule a call at fnrpusa.com/call. and either myself or one of the investor relation representatives will get back to you.
Andres wants to know if the slides will be allowed to be shared. And that's the first question. Okay.
Jeremy, I believe we'll have a recording of this ready, right?
Yep, and I'll put the slides up there with the recording. And then he also wanted to know about slide 27 with the list of properties, the deal details. He gave us his email, so I will make sure I pass that along to you guys. But he's interested in that.
Okay. Great.
All right.
Yeah, we'll be able to get you a recording of the webinar as well as a copy of the slide deck. Anything that we provided today on this call, we'll be able to furnish you with a copy.
All right. So another question, as we saw a lot of different anchor tenants besides grocery, what are some of the other attractive tenants?
Yeah, it's a great question. And we really try to focus on not only the grocery anchored, but the necessity-based space. Things that during a pandemic like we recently saw in 2019, where stores were shut down, we want to be heavily weighted in properties that remain open under any conditions. So to give you a feel for that, that might be department stores, names like Lowe's, Home Depot, we have in our portfolio. We have a really nice property called Cross Keys in Missouri that's anchored by a Schnucks grocer, as well as a Home Depot. We just closed on another property called Greyhawk in Omaha, Nebraska. That was anchored by a very high performing Lowe's. So those are the type of tenants we usually like to work with. If they're not grocery anchored, we want them to at least be necessity based. So sometimes you might see dollar stores in there, things of that nature, but primarily our anchors are either going to be grocery or necessity based. So that's what you'll see from us. But we also, of course, we have multi-tenant centers where there are some smaller shops, maybe mom and pop shops, but I would say about on average, 70 to 80% of our properties are national brand tenants. And then about 20% might be a smaller share of tenants that complement the center, whether it's a salon, a pizzeria, something along those lines.
For your model, is there a certain square footage or location to interstates that you guys usually look for?
Yes, that's a great question. And part of that whole Dragnet acquisitions approach that we spoke about a little earlier, we have an entire team set out on the acquisition side, which is analyzing every aspect of every deal we do. The state it's located in, the amount of vehicles per day that pass the intersection, all of those things come into play. So we're looking at household incomes, population density, really everything that could affect the center's performance. You know, we're looking at trends. Are there other companies that are opening up shops in the area? What are the barriers to entry? So, you know, we could go on for days. I think that there's about 60 check boxes that need to get checked off for us to acquire a deal. And if even one of those aren't checked off, we'll go on to the next. So again, if you wanted either a summary of our acquisition criteria, can provide that to you, and would be happy to share some of the details of what we look for when purchasing a property.
Okay. Chase said, great presentation. He's curious, or he or she are curious, does conduct a cost segregation study? I know that's one of the bigger benefits to CRE.
Yes. So Chase, we do a cost segregation study on every property that we purchase in the portfolio. For anyone on the call that's not familiar, in a quick summary without going off on a tangent, you could depreciate commercial real estate over a certain period of time, depending on the asset class, whether it's 39 years, 27 years in a straight line method. So to give you an example, you buy a $39 million shopping center. On the straight line depreciation method, you could depreciate $1 million a year. When you do a cost segregation study, what we do is we have a team of engineers, tax experts go analyze a property and take a look at everything, take a step back and say, okay, over a 37-year period, commercial real estate depreciates. There's going to be items that depreciate much quicker, whether they're characterized as a 7-year depreciation, 15 years, so on. And we're able to take a very sizable paper loss in year one. So what a cost segregation study does is it accelerates the depreciation over that 39-year period so that you're able to take a very sizable piece of that in year one. So to give you a ballpark figure, for someone who invests $100,000 in one of our deals, they may get a K1 where it reflects a $50,000 to $60,000 paper loss in year one. And if you are a real estate professional, you could utilize that for taxable loss against ordinary income. Of course, I'm not a CPA or tax advisor, would recommend that you consult with a CPA or tax advisor for questions on this. But yes, the cost segregation study will accelerate it. So you'll take a sizable year one loss and you'll be able to utilize that against the income that this property is deriving, as well as potentially ordinary income if you are a real estate professional, which the Iras defines as an individual who spends over 750 calendar years in real estate a year. So again, don't want to go too deep off. The direct answer is yes, we do provide a cost segregation study on all of our properties.
Very nice. If investors reinvest cash distributions back to the fund, can they optimize tax by taking advantage of 1031? That's from Ping.
So Ping, the only thing with the Opportunity Fund is that there's really no way to do a 1031 in or out of the fund, since there's a lot of moving pieces, different variables, so to speak, as we continue to allocate towards new properties. But with that being said, and again, would recommend you consult a CPA or accountant, but the feedback we get from most of our partners and investors of the firm is that when we do these cost segregation studies and accelerate the depreciation, again, you're able to utilize that against your taxable income that this investment would create. So for anyone who is not a real estate professional and say can't use all of that income or that depreciation in year one, they'll be able to carry that forward into following calendar years. And that is what the main benefit of the depreciation is that you won't have much of a tax liability, if any.
How many investors do you typically take on a per deal?
So I would say deal by deal basis, it's going to range, of course, by the quantity of money that we have to raise. A $30 million property is going to have a lot less investors in it than a $70 million property. But to give you a ballpark figure, our average investor probably invests around 150 to 200,000 in any given deal. So if we're raising $20 million in capital, you could assume there's probably going to be about 100 investors in that deal, 200,000 each. So for our larger deals, we might see upwards of 200 investors. For some of our smaller deals, there might only be 40 or 50. It's also going to differentiate depending on the weighting. We might have a couple large allocations that fill up the majority of the deal, but again, on average, 150 to 200,000 average ticket size, and then you would just divide that by the amount of capital we raised to get a ballpark figure.
Okay. Can people invest with their IRAs?
Yes. So for our individual deals, you can invest with your IRA. Again, it's a process in which you just have to have a self-directed IRA. If you don't already have your funds in a self-directed IRA and are looking to invest in these types of properties, we have different IRA custodians that we could refer to you. There's a couple that we've been working with over the past 7-8 years now that we could provide references for, and a couple that we've sent business to over the years and will provide us with a bit of preferential treatment in terms of the fee structure for the IRA setup. So yes, if you're interested in making an allocation, investing in one of our deals via your IRA, whether it's already in a self-directed IRA custodian or you just have questions about what that even means, again, please go to fnrpusa.com/call. And either myself or one of the representatives from the team will be happy to schedule a call with you.
Let's see. How often are distributions sent?
So distributions are sent out quarterly. We work off typical calendar quarters. I'm sure everyone aware on the call is familiar, but just to go over, January, February, and March constitutes Q1. That distribution is sent out by April 20th. So all of our distributions are sent out within 20 days of the calendar closing. So our distribution dates are April 20th, July 20th, October 20th, and January 20th. Along with the distributions we send out, we also send out full quarterly reporting, which goes over updates to the property, whether it is updates regarding capital improvements, leasing activity, any type of changes to revenue. Those will be indicated in the report, as well as an operating statement below, so that you can see quarter to date as well as year to date information.
Okay. So what effect does rising interest rates and inflation in the economy have on your assets?
So overall, anyone who's familiar with commercial real estate and real estate in general really knows that typically when rates go up, cap rates also track alongside with that, which means as interest rates go up, property values of real estate typically go down. Fortunately, what we're seeing right now in this space is that there is an extremely high demand for grocery anchored, necessity based commercial real estate. We're seeing that over the past couple of years, cap rates have gotten so compressed in multifamily industrial space where things are trading at 3 caps. Valuations are really high in certain aspects and cash flow is low. So we've been seeing a very high demand for the grocery anchored necessity based space from individual investors that are selling some of their multifamily here and looking for alternatives in the grocery anchored necessity based space. So our forecast is that although rates are continuing to rise, there's such a high demand for the grocery anchored necessity based space, which really didn't have a spotlight on it until COVID hit. So a lot of institutions are rebalancing portfolios and then pair that with the office space getting really hit and annihilated in 2019, 2020. And there is a lot of inflows of money coming into this grocery anchored space. So as rates go up, we are still seeing cap rates compress, maybe level off a little bit. So our forecast is that's going to continue to occur. There's a large demand for the space, and as rates go up, we think that cap rates are going to continue to go down, if not stabilize. And fortunately for us, the majority of the value that we provide on a property is through the lease up of vacant space, extension of lease terms. We're looking to bump our net operating income and our weighted average lease term up. That's how we provide value, rather than some other sponsors that might just be looking for cap rate compression. So the good news is that even if cap rates don't continue to compress, we're going to be adding a tremendous amount of value to these properties based off our leasing initiatives.
Okay. What's the average hold period?
Average hold period is between 3 to 5 years. Historically, in the past, we've done a lot of longer term hold periods, whether they're 7 to 10 years. What we've found is that our investors like to not tie up their capital for extended amounts of time. So our sweet spot is typically a 3 to 5 year hold period, which is what you'll typically see on our offerings.
All right. Does FNRP invest in their own funds or deals?
So, no, I'm sorry, Jeremy, was there a second part to that one?
No, you got it.
Okay, great. Yeah, so FNRP does have a position in each and every one of the funds that we bring out, or deals, I should say. So yes, FNRP does have skin in the game, so to speak, and is an investor alongside all of our limited partners in the deal.
I assume you guys also have an investor portal?
Yes. So we utilize Juniper Square, which is the investor portal software. If you're not familiar, it's very much so like a TD Ameritrade Fidelity account. When you sign your documents and become an investor with us, the next step before you even fund the investment is to onboard you to this investor portal. And what you'll see there is an active summary of all of your capital contributions and distributions that have gone out to date, a copy of all of your executed documents. That is also where your K1 is going to go come year end. We have a tax center in the portal. And that's also where you're going to go if you ever need to adjust payment instructions, mailing information, email, password. So yes, we do have a portal provider, Juniper Square.
All right. Well, we have about 1 minute left. Is there anything else you want to let people know?
I want to be cognizant of everyone's time here. What I would say is for anyone who is attending their first webinar of ours, we really appreciate you coming on. Aside from your capital, we know time is one of the most valuable resources that we could have. So we appreciate you coming on today. For anyone who's returning to another webinar of FNRP, happy to see you on. Again, appreciate your time. And for anyone who may have not had the time to ask a question or thinks of something in the coming hours or days, please go to fnrpusa.com/call to schedule a call with a member of the investor relations team. Either myself or someone from the team will be happy to get you on the phone and answer any inquiries you have.
All righty. Well, thank you guys. We'll be working on getting the recording up and along with the slide deck. Thank you again. If you have any questions, just reach out to me or Sam or Drew. Have a great day.
Thanks, everybody.
Thank you, everyone.